going on, everybody? Hope everybody's having a great Wednesday night. Welcome to week 4 of the Option One-on-One series. All right, let me make a few announcements in the group, and then we'll go ahead and get started probably at 7:35 p.m. I got some cool things planned for us tonight. As long as we have the setup cooperating, we're gonna do some cool things tonight with the TOS platform. So, if you have attended a class before or reviewed all of the recordings, drop a 1 in the chat. If this is your first time attending, drop a 0. All right. Seeing some ones. Great, great, great. So we'll give it a few more minutes. Like I said, we'll get started at 7:35. I want to give folks at least a couple of minutes to come in and get settled. But today, what I wanted to do was utilize the Thinkorswim platform just to play around with some of the basic order types that we learned last week, and to just get a common sense of how options really move as we play with different parameters, right? So we'll play with a little bit of swings, we'll do a little bit of day trading, a little bit of scalping, and we'll play around with the strikes and expirations and really show how that affects the overall trade, right? Because I think that's very important that you have a clear understanding of how expiration date selection, strike selection really affects the trade that you're looking to take, right? So we're going to utilize Thinkorswim on demand feature and simulate some trades today based on, some feedback on the audience. And we're going to see, make some predictions and then kind of see what happens from there. All right. So if you're excited about today's lesson, drop a 5 in the chat. Love those 5s, seeing those 5s come through. Great, great, great. Still got about 2 more minutes before folks come on in. Y'all are here, so I know folks should be able to find the Zoom link. So it is 7:35. So let's go ahead and get started. Before we get into the simulated trading, I want to ask you all like a couple of preliminary questions. First question is what are one of the three driving factors for option price? Right? What are one of the three main things that drive option price? Type out your answer in the chat. What are one of the three main things that drive option price? Okay. So one of them is outright correct. Correct, Brittany. Volatility definitely drives option price. All right. Another point was time. Right. And I'm going to just give you all a brief overview. All right. Let me reshare this screen over here. So remember what drives option value, right? Volatility, time, direction, right? We know that when volatility is higher, option prices are higher, right? When we're looking at time that is further out, right, and expiration, that causes option prices to be higher, right? And then direction, depending on where current price is going and depending on what type of contract we want, that will also drive option price. For example, if we want calls and the stock price is going down, those calls are going to be cheaper, right? Versus if we wanted calls while the stock price was going up. All right, so this is just a brief reminder. This was, I believe, class week 1. All right, so we know that these are the three main drivers of option value, right? And to my point, that my guy or girl Kay said Greeks as something that drives option value, he or she was correct, right? Because these values, right, volatility, time, and direction, these factors are quantified into numbers that we refer to as the Greeks. All right. So ultimately, um, what we can do is we can modify two things. All right. So I'm about to go back to our TOS screen. All right. So in an option contract or in an option trade, there are only two things that we can change, right? That is at our discretion, right? The first one is the expiration date, right? We as a trader can choose the expiration date in which we trade at, right? We know that the further out in expiration date we go, the more expensive these contracts will be, right? The closer in expiration we go, the cheaper they will be, all right? So the first thing we can change is expiration. The second thing is once we change expiration, we can then change the strike, right? And depending on what strike we choose will determine everything else, right? So I want y'all to really understand that process, right? You're choosing the expiration, right, on your trading platform. And then the only other decision that you're going to be able to make is you're going to choose a strike, right? And the way that you choose your strike is going to be a combination of a few things, right? One of the things are going to be looking at the Greeks, right? The other thing is going to be looking at the charts, right? And then the last thing is going to be looking at the actual overall option flow, okay? If you're following me thus far, drop a 4 in the chat. Okay. So first question we had to ask ourselves, right, is what expiration date are we choosing, right? So the expiration date that we choose is always going to be based on how long we think it's going to take the stock to make the move we want it to make. All right. So right now we're looking at NVIDIA, and we see NVIDIA at this time is trading at 220. All right. Now let's say I had a price target for NVIDIA of 240 for various reasons. All right. That is a $20 move. So as the decision I have to make first is, well, how long do I think NVIDIA is going to take NVIDIA to make that $20 move? Now, we're not going to get too far into the charts today, but based on things that we look at in the charts and maybe in underlying flow, we'll make a decision that says, I think NVIDIA maybe could get to make a $20 move in 7 days, right? 7 trading days. All right. So once we have made that analysis, then we look at the option chart. At the option chain and say, okay, if I think NVIDIA needs at least 7 days to make the move that I'm interested in, I can't choose an expiration date that is before 7 days. So as you see on TOS already tells you how many days until the last trading day. So this one's 3, 10. Can y'all see these numbers, or are they too small? Do I need to make the screen bigger? If I need to make the screen bigger, drop a 1 in the chat. All right, my bad. See, I got to say something. I was just going to sit there and struggle. Couldn't be me. All right, I got y'all. Give me 1 second. Is that better? Drop a 1 in the chat. You can kind of see those numbers a little bit better. Actually, there we go. Cool. So as you see, if we said maybe NVIDIA needs 7 days to make this move, well, we definitely can't look at expirations for the 17th because that's shorter than the time we think. So usually when you're choosing your expiration, you want to give yourself more than enough time for that move to happen, right? Because if you go in less amount of time, you're taking a more aggressive stance. You think that that move is happening quicker because if you're wrong and the move doesn't happen as quick as you think, you know that that option contract is likely going to be a losing position. So the first thing you want to always decide to yourself is how long do I think this trade is going to take? Because that is going to allow me to choose my expiration. All right. So once we know, okay, 7 days, that means for in this situation, everything from the 24th on is something that we can consider as a possible position. Right now, we know that and I'm just going to look at a few strikes. We know as we go further out in expiration, right? So I'm gonna open up 3 weeks. We know if we go further out in expiration, we can see that these contracts get more and more expensive, right? The 24ths are running at 985, so we know that's $985 per contract. March the 3rd, right here, the same strike is 1155. So we know that that's about $1,100 and $1,155 per contract. And then out to March 10th, these are 1305. So that would represent $1,305 as a contract entry price, right? So we clearly see that as we add more time or have more time buffer, right, it's going to cost us more, right? Now, one might ask themselves, well, why would I do that, right? Why would I buy more time if I only think it needs 7 days and I see I can buy something with 10 days? Why would I buy something that's 17 days out or 24 days out? And the reason is because of theta. What do you notice about theta as you go out in time, right? You notice that theta is getting smaller, right? Because the further out the contract is, right, the less theta decay you're going to experience, right? And as a reminder, theta is the amount that a contract loses over a 24-hour holding period, right? So how much a contract loses if you hold it for a day. So essentially, if you go out further in time, right? If you go out further in time, you see that these contracts have a smaller theta drain, right? One, it's a smaller absolute theta drain. Two, it is a smaller amount of the total amount invested in the position. So, for example, $28 is a smaller percentage of 1,200 than 50 is of 795, right? So the reason why somebody might buy more time is because if they know that they're going to have to hold it for multiple days, maybe they don't want theta or time decay to pull on their position. Does that make sense? Drop a one in the chat if that makes sense. All right. Now, what we also notice, right, is once we notice that, of course, one of the deciding factors of time here is, of course, theta decay, but it's also going to be position cost, right? At some point, you are only going to be able to afford X amount to put in a trade. So you can only look but so far out before the positions cost you too much to enter. Okay. So that's one thing. Right. Now, this leads us to the next question, right? What strike do we select, right? We know we have a target of we know we have a target of 240, right? What do we choose as a strike for that move, right? And there's a couple of different ways that we can think about this, right? One of the ways is, right, how aggressive or how confident am I that Nvidia is going to get all the way to 240, right? If I have a lower confidence in that ultimate target, my contract selection as far as strike needs to be closer at the money or maybe even slightly in the money. The reason is because of Delta, right? Relating this again back to last week. We know that Delta is the change in option contract price given the dollar move in underlying stock, right? So basically saying if Nvidia went from 220 to 221, how much would this option contract move? That's what Delta tells us. And we know the only thing that really changes Delta is our strike, right? As we go up, Delta goes higher. As we go down on the call side, Delta goes lower. So, if we don't think Nvidia is going to make a strong move, those first couple of dollars need to mean something, meaning we need to have a higher delta for those first couple of dollar moves. We can't afford pennies on the dollar for those first couple of moves because we don't really have confidence that Nvidia is going to make that full move to 240. So to account for that lack of confidence that Nvidia gets to ultimate target, we buy contracts that are a little bit further in the money, right? Because they have a higher delta. That first dollar move is going to give us a higher return. So ultimately, even if we are right, we are still going to make a good bang for our buck. Does that make sense? Drop a five in the chat if that makes sense. If that doesn't make sense, drop a six. All right. So I love it. We got a six. So let's let's pause this. Let's go to the chart real quick. I think we were looking at in the video. What is this? I was wondering why that looked like that. Let's choose a different name. I don't know why that chart is just started like that. Okay, we'll just use Apple. So let's just say in this situation, right? Let me first see some. See where Apple goes after this. Okay, cool. So let's just go back. So let's just say we were in this situation, right? We thought Apple was going to go up, right? Now, your ultimate target for Apple going up might be this gap fill, right? Where Apple closed yesterday. If you bought a contract on Apple, so let's say we bought these 172 fives that were slightly in the money, got a delta of point 0.7 versus a contract like these 177 fives. So let's buy these real quick. Buy them at market, confirm and send. We show you those are bought. At the same time, let's buy these 177 fives. One contract, confirm and send. All right. So we go back to the chart real quick. Let's fast forward this just a little bit. Speed this up. So we had this Apple position open. Okay, so let's go back 3 minutes. All right, and let's see where we're at. this back up real quick. All right, bam. So we bought these contracts relative at the same time, right? And we can see from a profit just from a dollar amount, we were able to make $17 on that move versus $7 on the move for the same price move. Now that's because the move wasn't as aggressive, right? Now as this move gets more aggressive, what we will see. Let me add this in right here. P and L percent, and let me take away some of this other stuff. All right. So here's the phenomenon that is seen, right? From a percentage standpoint, hey, I made a higher percent on my 177.5s on that move. But from a dollar standpoint, right, on absolute cash, I made more on the in the money contract. And that is because the in the money contract yielded me a higher delta, which is going to give me a higher change in the actual value of the contract per dollar move of Apple versus a contract that's further out of the money that has a smaller delta. Does that make sense? Seeing it like that? Because as I press play and we watch this, right, and these contracts update, note that this is outpacing it from a percentage standpoint. But again, from a dollar standpoint, I am still outpacing, or it is still outpacing the return, right? Now, we know in this situation, eventually that Apple does make that strong run up move, right? But let's just say, yeah, we know Apple ends up making that crazy move, right? But let's just say it doesn't, right? And we pause it right here. And we pause it right here. We have to, on a one contract basis, we were able to gain a bigger dollar return going a little bit further than we were able to by going a little further out of the money, right? So this kind of leads to the thought of when you're choosing your strike, it's all about how aggressive of a move do I think is going to happen? Because if it is going to be aggressive, then going out of the money is going to be better because you're able to yield a higher percentage, and if you match the initial investment on a dollar amount, right? You'll make a lot more money. So what I mean by matching on a dollar amount is technically for what I bought of one contract here, I might could have bought of three contracts here, right? Investing the same 350 bucks. But that one contract and those three contracts are going to move differently, right? Because now on the out of the money contracts, I have a multiple. I have three of them, so they're going to move. Is going to be a lot more volatile than me managing one, right? So it's a give and take. Are y'all understanding um, this example? So let's keep watching it. So let's fast forward. All right, go back up just a little bit. So let's just pause it right here. So again, at this point, as we see, we've outpaced it from a percentage standpoint, but again, from a dollar amount, on the same contract basis, we were able to get a higher return. Now, let's see, let's just go back. And let's just say in this time we bought let's buy two. Right? So now together we have three versus this one, pretty much the same. We can add this to see net liquid. Add. We can see roughly, even though that this is a little bit smaller, actually, let's just add one more. So roughly now around the same size. All right. Now, when we max out the same amount of capital invested, not on the same contractual basis, what we will notice. Oh, went a little bit too far. Let's go at the peak or close to the peak. All right. We will notice that again now on the same dollar basis, we do make more money. Right now, here's where here's where you have to consider the downside of that, right? Because if you're right, that works out. Now, if you were to get greedy, continue to hold these, right? Because we kind of know what happens a little bit. Oh, now if we pause it here and we compare, this was vastly up more. So this on the pullback lost money a lot quicker than that one contract. So again, it goes back to your risk management, what you're comfortable with. Because when you added the same amount of capital, but you went on that out of the money contract, which now you have a higher quantity, these numbers are moving a lot faster, right? It's a lot more volatile. Did y'all catch that? Now let's see something, because let's see where Apple continues to go. I don't know. Now let's see something. Get towards the end of the day. Okay. So let's just say you're like, man, I've still in the same day, you're still holding those same contracts. Let's check in to see how our contracts have moved since when they update back up. So right now, still somewhat the same, right? We're noticing because we're still in the same day, data has not really taken in effect. so much on our contracts, right? Now let's just fast forward to tomorrow at open. Oh, so tomorrow at open. Oh, actually, let's not even. We ain't even got to do that. Let's just go back to the same day. Let's just go 14. So now you done held, you done stepped away, you come back. Now see that you holding those out of the money contracts, those have lost value a lot faster. All right, now these are only worth 32. All right, they've lost value a lot faster than the contracts that you bought when they were slightly in the money. Oh, even right now, because I think it just updated. Let's see what the chart's at. Yeah, right. So if you were to still have held these contracts at 230, right? These contracts that were slightly in the money when you bought them and still are in the money now, still are holding up their value a little bit during weathering the storm, while these contracts that were out of the money when you bought them, they're not weathering the storm as well, right? And especially if we go back, what time is that? 2:15. I'm letting this say stop pre-buffering, and then I'll switch back over. All right. So now we can see towards that bottom that again these in the money calls kind of weathered that storm a little bit more than those calls that we bought that were slightly out of the money. Now, how many times have you heard somebody say, I'm going to average down, I'm going to scale in, I'm going to add to my position? How many times have you heard that? Is that something that y'all have heard before? Drop a one in the chat if you heard that before. Drop a seven in the chat if you knew what that meant. So exactly, a lot of folks don't know what that means, right? So what that means is you see our trade price on these contracts. We got in these at 353 or $353. We got in these at $92, right? These are currently $224 and $50. So if somebody was to say, I'm going to average down or scale in, essentially what they're saying is, I'm going to buy more contracts, right? So let's just say I bought one more of these, right? Which would be about 240 bucks. So I come over here to these, not 224 bucks, excuse me. And let's just say I bought one. Cool. So now that I bought that one and we check my trade price, we see that my average cost of my trades have gone down, right? Because I bought one at 353 and I bought one at 225, which gives me an average cost of 289, right? So now I am down my total profit and loss percentage is actually down less than it was, I mean higher than what it was because my average cost for my total position has gone down, right? And the market price right now is staying the same. So if I average down, let's just say I spend the same 200, so that would mean I'll buy four of these at $50. See, that costs me 200. All right, I've averaged down, and now my average cost on these are 71 cent, and my average cost on these are 289. All right, so we're gonna go fast forward a bit. So we see price has recovered some. All right, so let's check into our positions. All right, so what do we notice on the recovery? Because these contracts were closer to being in the money or were already in the money, on that small recovery, we were able to gain a greater increase in our position of loss, right? Because the delta was higher, right? That small move still related to a bigger move in the mark price versus on our out of the money contracts where we averaged down. Yes, it also made a good move, but from a dollar amount, it did not make the same move in contract price. Does that make sense? Drop a nine in the chat if that makes sense. So let's go back. Nope, not a problem. Let's go back. All right. So when we bought in, the delta on these 177 fives were 18 cents versus the delta on these 172 fives were 52 cents. So for a dollar move here, these contracts going to move about 52 bucks, right? So from about 224 plus 52 is how much we could expect these contracts to move if Apple goes up a dollar. For that same dollar, if Apple goes up, these contracts would only go up about $18 in value. Okay? So when we fast forward 20 minutes, right, and Apple has started to make that move back up, it hasn't made the full dollar move, right, but it's made about an 80-cent move. What we will notice is, and let's just go back real quick so we can look at something. So we were down about 30% on these and about 22% on these. In that next 20 minutes, you see we're about 9% on these and we're still down about 16% on these. These were about 49 cents, right? These were 224. So we gained in this situation about $36 per contract, right? Back on that move versus on this, we made about $10 per contract back on that move. Does that make sense? So on a day trading basis, that does not, it's somewhat similar, but watch what happens. And the purpose of what I was going to do was when we go to the next day, let's just say we decided we were going to hold these contracts and we swing them one day and we get to market open at 9:30. First 30 seconds. Market's been open 30 seconds. And we get there the next day. Apple gap down, right? So when we check these contracts now, right, again, one, we see how theta affects it. So I think this would actually been a good example. So let's go back. to 1600, which will be 4 o'clock. So at the close of this day, if we had these positions open, once it rebuffers out, if it rebuffers out, right, at the close of this day, right, we were down about 26% on this position, about 20% on that position, right? So when we fast forward to the next morning at market open, this will show you the effect of theta. When we open that market open, we can see automatically these contracts have lost and has lost value. One, because the market opened lower than what it closed at, and then two, because time has passed by. So let's just see how this day plays out. Let's just go fast forward midday. So let's go tomorrow midday. I just want to see what happens the rest of the week. Perfect. So we hold these contracts throughout the whole week with the thought that we just knew Apple was going to go back up at some time. And because we held these contracts, and these contracts are updating a few, but because we held these contracts, which now both are out of the money, right? Apple's at 164. We have a 172.5 call and a 177.5 call. These contracts are worth nothing, right? So we look at the option chain. These contracts are very far out of the money. We're barely getting any delta per movement because it is very unlikely that these contracts will be in the money by close. So they are worthless to the market, right? So because at the end of the day, right, any contract that expires out of the money has to be worthless. It has to be zero, right? So I was wondering because I didn't know what Apple was going to do in this situation. I just chose a random date. But let's just say Apple had. Let me look at the chart. Let's just say Apple throughout this week would have held this 172 level, right? If we would have, because we bought that original position in the money, as long as we would have been able to maintain that position being in the money, it would have held value. But as those positions were out of the money and started to go further out of the money, right, we noticed that value started to deteriorate very, very quickly, right? So this is the trap that you get into when you're buying contracts that are too shortly dated, right? Because let's just say, for example, and I don't know what happens, let's just go to the end of the month. So let's just say we get to the end of the month and Apple finally makes that move up that you were looking for up to the 175 level, right? Now, this is the part of not buying enough time because you bought that weekly that expired on April the 19th, you couldn't sit through any of this drawdown, right? Because that contract was losing value each day that it approached the expiration. But had you bought a contract, you know, 2 months out, a month out, right? End of the month, start of the next month, even through this drawdown, you maybe could have averaged down, scaled in at the bottom, and still been able to ride a recovery in the next few days to come. Does that make sense? I know this was a really long winded example, but I hope you all were able to kind of gather a little bit of how the Greeks, at least the main two Greeks, delta and theta, kind of play a factor um, in the trading. If you were able to gather that, drop a seven in the chat. And ultimately, delta and theta is a fancy way of saying choosing your strike and expiration. I hope that this example showed you the importance of choosing the right expiration and choosing the right strike, because choosing the wrong strike or choosing the wrong expiration lead to bad Greek selection, which leads to the contract not moving in the way that you thought it would move. So I really hope that this was able to kind of relay that for you all. Any questions? Because I wanna have a little bit of more extended time for questions, and we'll make it an open mic session. So feel free to unmute yourselves.
I have a quick question. This is Brittany.
Yep, go ahead.
When you buy a contract that has a further out expiration date, it costs
Hmm.
more money, right?
Correct.
So, how do you calculate um, the cost of the move of the stock versus the actual cost of the contract to see if it's worth buying a further out expiration or a closer expiration for less money? Do you get what I'm saying?
Yeah, no, I get you. So the best way to do that, I wouldn't. There is a manual way. You wouldn't want to do all of that math. The best way is to use an option calculator. So they do have one in. Um, they do have one in TOS. So for example, let's just say I wanted to. Let's take it back to the 22nd. All right. So let's just say Apple's down here, and I was like, I want to know if buying a, so let's just say in the week 170, let's just say 170 will go down to, well, you don't let me do it. Oh, there we go. Add simulated trades. So I can check that, change my, click off, go to my little risk profile, and it should show me. Oh, they won't show it to me live. I can't do it on demand. But essentially, what you could check is pretty much layer your simulated trades, and as you moved along this line, it would tell you how much profit you made based on the price of Apple. And as you kind of see here, it kind of changes the date, so you can manipulate up here, like, where it says like expiration, and we'll go here. Oh, I see why it's doing that. Because this is, what day is this? April. I never tried to doing it on demand trading. All right, I got another option. Give me 1 second. Option strat. All right, let me share my screen over here. All right, so a website that I like is Option Strat. It's a free option calculator. They have an app and they have a website. So if we were looking at Apple, and we're not going to really be able to back test, but it's going to take on current pricing. But what we could essentially do, right, is compare. They have, so we're looking at it in the table, but we can look at it in the graph, and we could choose the parameters. Actually, we'll look at it on the table. And we can manipulate, let's just say, all right, we chose a 235 strike for April the 4th. This is the date going across the top, and this would be the profit and loss expected based on what price Apple is, which is over here on the y-axis. So you can compare this to a further out date, and you can see how the numbers change based on when you think Apple could reach that move. So they kind of already have selected kind of price increments and dates for you, or you can flip it over here to your graph, which is going to be more specific because they have the slider down here at the bottom, so you could choose the exact date that you're thinking about, and then based on what price Apple is, it could give you a possible return on the position that you select. And again, you determine the position here, like the quantity that you that you bought, and then the price that you paid for it. So you can kind of manipulate and play around with different option contracts and potential returns. One reason why I really love this, option calculator, because unlike one that you see on Robinhood, you can change the implied volatility. So if you're thinking that maybe you're going to go into a more volatile environment, you can make the implied volatility go higher. Or one of the uses that I love is, let's say implied volatility is really high in front of earnings, and I want to simulate a earnings crush. I can simulate implied volatility going down 25-30% and still kind of have an idea of what that contract that I bought could be worth the next day it opens. So this tool is, another great tool. I'm glad she asked the question because it was one of the tools I wanted to go over today in our platform walkthroughs. So I hope that answered your question, Brittany. Any other questions? Please feel free to unmute yourselves, ask. There are no dumb questions. I'm here to help. Anything along the lines of, you know, basic order execution, strike selection, we're here to have a little bit of dialogue. I try to create a little bit of more space tonight to make sure I gave y'all time to interact and ask questions. So please take advantage.
Okay, so can I ask the question then about the implied volatility?
Sure.
How do you calculate that to say, times one, times two, times three? How do you know how to adjust that based on like your scenario of an earnings, a pre-earning scenario?
Oh yeah, another great platform question. So let's switch back over to TOS real quick. Y'all gonna know I love TOS. So in the live area of TOS, or I could have done it in on-demand trading. You can go under the Analyze tab. They'll have this area called Earnings. And when you go on Earnings, you can type in any ticker. Right now, I was looking at a firm recently, right? And you see this area that says Implied Volatility. And usually what you can see here is this is the stocks implied volatility, but you can kind of see that okay, it was at 147% and it dropped down to 117 117, and these represent days. So from one day to that day, it had about a 30% IV crush, right? Next time it had earnings, it had about a 19% IV crush. So that kind of gives you an idea of the type of IV crush that you might be looking at, just kind of based on, and these are the last 8 quarters. And then you could take that information and then utilize that to say, okay, if IV's at 110 before earnings, on average it goes down 20%. So let me factor that into my calculations. Which is why a lot of times I don't play earnings, because after I've done the math, I usually need too big of a move for the thing to be profitable. So let's just actually do a perfect example, and this gives me a chance to show you all some more tools. All right, so let's just go and let's just see. I'm going to add a scan to see maybe. Public upcoming earnings. Actually, I know something that had earnings. I think it was Marvel. Yep. Okay. So Marvel had earnings. Okay. So let's look. Marvel had earnings based on Portia's question. We can see Marvel. You can see implied volatility was at 58, dropped down to looks like 47. Implied volatility was low, 59, dropped down to 52, 56, 41. Last one was 54 to 40. We came in hot this time with really high applied volatility. We hadn't had that high in a while. Last time I had an implied volatility that high before earnings was here. Dropped from 71 down to 53. So that's at least a 20% drop. And it's a little bit higher. So based on Portia's question, right, how do we kind of calculate that? If I go to Marvel, and let's just share my screen the other way, right? If I go to Marvel on our option strat, type in Marvel, and I say, I'm thinking about playing earnings. I know they went down, but let's just see. Let's just say, because it closed at 90.14. Let's just say we were looking at puts that expired this week, and we were looking at, $90 puts. Right, at close, those puts were about 520. Okay. Now, we see that, and again for that, I forgot that this actually accounts not just for the implied volatility of the stock, but the implied volatility for the whole contract. So let's see something. Let's just say, for an example, on these $90 puts, we go to tomorrow, which would be tomorrow at 9:30 in the morning. Right. When you look at your Robinhood one, right, your Robinhood simulated returns, it would tell you that, oh, this only has to be below 88 for you to have made money, right? On how many contracts did we buy? On one contract. Now, when you take implied volatility into a factor, if the total stocks implied volatility is going to drop a total of 20-30% on a contractual or on a weekly basis, we're looking at a 50, 60, 70% drop. So let's just take this implied volatility down to like 100, right? Now, instead of it dropping below 88 for you to be profitable, it had to make a drop below 85 for you to be profitable, right? Now, if I look at, I'm just looking at I'm just looking at the usual affirm volatility, and I'll actually show y'all this real quick because it's a good learning lesson. So when you look at implied volatility, the implied volatility that they're referring to, I don't know why I'm looking at affirm at Marvel, right, is the implied volatility per contract, which is highlighted over here. Right, you can see that says 200%. Right, but you can see on other weeks that are not earnings, that number drops down as close as 89 and as low as 56. Now, the closer you are to earnings, it's still going to have that implied volatility be a little bit higher. So if we want to kind of get a better feel of really where it normally is at, let's look out at like a month or two, right? So a usual implied volatility constant for Marvel is around, looks like that 59, 60, 60, well, maybe we'll call it 65. So when we go back and look at our option calculator and we take that implied volatility all the way down to about 60, 65, right? We notice that now we have to have at least a 6% move on Marvel after earnings for us to even be profitable buying at the money contracts, right? These are us buying at the money, right? Let's say if we bought contracts that were, let's say we bought $85 puts because they were cheaper, right? Because those are only $238. Well, then you would have needed Marvel to make a move all the way down to 83. Let's say you was being really cheap and you bought $80 puts because you thought Marvel was going to just totally miss earnings, right? Well, you would have needed for those to be profitable a 12% move on Marvel to the downside before you would have even started seeing any real money on those $80 puts, right? So this is what happens when people get IV crushed, right? Because they only account for price move, but they don't account for the volatility constant because volatility will drive option value. If that volatility doesn't drop a lot, well, your break-even price is a lot higher. Does that make sense? Hope everybody else really gathered something from that example because it talked about IV, but it really, what the real main takeaway should have been there is how implied volatility really plays a factor in option pricing. All right, because as I moved that contract, essentially what the break even price is telling you, because as we move along this line, really what it's telling us, and let me just show you, make this contract value, right? What it's showing us is the value of that contract, right? Now look at again the how if you play with implied volatility, it kills the contract, right? So if we're looking at 84 and implied volatilities here, these contracts are worth 4 cents. If we look at that same area and implied volatility is a lot higher, those same contracts are worth 385. So again, the main takeaway of this should be the factor of what volatility plays in option pricing, right? And that is why when you trade options on names like Tesla, trade options on names that are very volatile in stock price, those options are typically priced a lot higher and value moves a lot crazier because it's not only price movement that's playing a factor, it's also that volatility constant. All right, I know y'all got some more questions. Let's keep it going. Any more questions? Well, if there are no questions, let me ask y'all a question. Um, what's some feedback from tonight's lesson? What's one thing that you learned, and maybe a piece of feedback about tonight's lesson? Anybody's welcome to chime in.